Client sees need to replace Carl. 6 words, handwritten in the notes of an Arthur Andersen executive, and printed years later by a committee of the United States Congress. I want to tell you who Carl was, because those 6 words are the whole case. I ended the last chapter with a question. Did Arthur Andersen fail to see Enron's fraud, or did it see the fraud and look away? After 20 years of doing this work, I can tell you the real answer is worse than both. Andersen saw it. Andersen wrote it down. And then Andersen kept the client. Carl Bass was a partner in the group inside Andersen that settles technical accounting disputes. The internal referee. He objected, more than once, to the way Enron was booking Fasto's entities. In 2001 he was taken off the Enron account. Now the fees. In the year 2000, Enron paid Arthur Andersen $25 million to audit its books, and another $27 million for work that was not the audit. $52 million. 1 client. 1 year. The firm hired to check Enron's numbers earned more selling Enron other services than it earned checking them. So when the client says it sees a need to replace Carl, this stops being a question about accounting. The control existed. The referee existed. He did his job, the client asked for him to be removed, and he was removed. That is not blindness. That is a safeguard that worked exactly as designed, and a firm that switched it off. Jeffrey Skilling became chief executive of Enron on February 12, 2001. On August 14, 6 months later, he resigned. He said his reasons were personal. The stock had come down hard from around $90 the previous summer, and the man who designed the machine walked away from it without explaining why. The next day, a vice president named Sharon Watkins sat down and wrote to Kenneth Lay. She had been studying the structures Fasto built, and she had worked out how they were funded. They were funded with Enron's own stock. Which meant that when the stock fell, the hedges failed at the exact moment they were needed. The company was insuring itself against itself. One line from her memo gets quoted everywhere, and it earns it. I am incredibly nervous that we will implode in a wave of accounting scandals. She wrote that on August 15, 2001. Enron filed for bankruptcy 15 weeks later. She met Lay in person on August 22. Lay ordered a legal review, and he gave it to Vinson & Elkins, the outside law firm that had worked on the very deals she was questioning. 9 pages came back. No wider investigation needed. I want to be precise about why this one stays with me. Watkins did not crack a safe. She read documents she was entitled to read, and she did the arithmetic. Everything required to see this was sitting inside a company of 20,000 people, and one of them added it up. On October 16, 2001, Enron reported a third-quarter loss of $618 million, and a reduction of $1.2 billion in shareholders' equity. On October 22 it disclosed that the Securities and Exchange Commission had opened an inquiry. The next day, in Houston, Andersen's audit team was told to make sure it was complying with the firm's document retention policy. That is the language that was used. In practice it meant shredding, and deleted email, and a congressional hearing 3 months later titled Destruction of Enron-Related Documents by Andersen Personnel. Then, on November 8, Enron filed the document this channel is named after. A Form 8-K, still sitting on the Commission's servers today. In it, Enron restates its financial statements for 1997 through 2000 and the first 2 quarters of 2001, and states that those statements, and the audit reports covering them, should not be relied upon. Sit with that second part. This is not only a company withdrawing its own numbers. It is a company publicly withdrawing its auditor's opinion. For years of signed audit reports, declared worthless in 1 sentence. Then the filing shows its work, in a table. $96 million off 1997. $113 million off 1998. $250 million off 1999. $132 million off 2000. $591 million of profit that was never there. Look at what that does to a single year. Enron reported net income of $105 million for 1997. Restated, $9 million. Earnings per share for that year go from 16 cents to -1 cent. Dynegy, a competitor, had agreed to buy what was left. It read the filings and withdrew. On December 2, 2001, Enron filed for bankruptcy. One more thing happened before the courts, and it is the part one would keep if you forget everything else in this episode. Enron's employees held their retirement savings in Enron stock. In late October, while the company was coming apart, the plan changed administrators and the accounts were frozen. Employees could not sell. The Senate held hearings on it, under the title Retirement Insecurity, 401k Crisis at Enron. The numbers entered into that record are small enough to miss. When the accounts locked, Enron traded at $13.81. When employees could sell again, it was $9.98. That gap is what the collapse looked like from inside a Houston cubicle. The shape of it is worth saying plainly. The people who understood the accounting had been selling for months. The people whose savings depended on that accounting were locked in a room and told to wait. I have never found a way to call that a technical failure. Andrew Fastow, who built the entities, pleaded guilty and testified against the men who had hired him. 6 years. Jeffrey Skilling was convicted on 19 counts in May 2006 and sentenced to 24 years, cut to 14 in 2013 under an agreement that ended his appeals. He left federal custody on February 21, 2019. Kenneth Lay was convicted on the same day as Skilling. On July 5, 2006, before a judge could sentence him, he died of a heart attack. Under American law, when a defendant dies before his appeal is decided, the conviction is vacated. Kenneth Lay is, in the eyes of the law, an innocent man. And then there is Anderson. On June 15, 2002, a jury convicted the firm of obstruction of justice. On August 31 it surrendered its licenses and its right to practice before the commission. 28,000 people worked for Arthur Andersen in the United States, and the firm stopped existing. On May 31, 2005, the Supreme Court of the United States overturned that conviction. Unanimously. The jury had been given the wrong instructions. Andersen won. By the time it won, the firm was down to about 200 employees. There was nobody left to hand the verdict to. In July 2002, Congress passed the Sarbanes-Oxley Act. It created the Public Company Accounting Oversight Board, a regulator for auditors, because until then the profession inspected itself. It made chief executives and chief financial officers personally certify their financial statements, under criminal penalty, with their own names on the page. And it barred audit firms from selling most other services to the companies they audit. That last one was aimed straight at the $52 million. Did it work? Partly, and I want to be fair about it. The structures Enron used are much harder to run today. Off-balance sheet vehicles get consolidated. Signing something you know is false carries a sentence with your name attached. But here is what 20 years in this job has taught me, and it is the reason I made this episode. Sarbanes-Oxley fixed the accounting. It did not fix the incentive. The auditor is still chosen by the company being audited, and still paid by the company being audited. Somewhere right now, in an office that looks nothing like Houston in 2001, someone is deciding whether to push on a number, knowing exactly who signs the invoice. Carl Bass pushed. Carl Bass was replaced. There is nothing in Sarbanes-Oxley that makes that impossible. I opened this case with an accountant destroying documents, and I want to close it with what he could not destroy. The 8K is public, and you can read it today. The Powers Report, written by Enron's own board of directors and released on February 1, 2002, walks through the transactions one by one. Sharon Watkins' memo sits in the congressional record. Those 6 words about Carl Bass were printed by the Congress of the United States. Almost everything you needed to understand this fraud was written down, filed with a regulator, and available, and most of it before the company failed. Fraud at this scale is not buried in a vault. It is filed on time, in the footnotes, in language built to be technically true and practically unreadable. The trail is always there. What is rare is somebody willing to follow it to the end. That is what this channel is for. Enron closes here. Subscribe to Paper Trail, and I will show you the next one.